the budget was relatively quiet from a corporate tax perspective, but I want to share a couple of announcements which are worth being aware of. So, full expensing, which is the 100% capital allowance that was recently made permanent, has specifically excluded leased assets. It was announced yesterday that draft legislation will be released for consultation to potentially expand the provisions and include leased assets. Now, this isn't a huge surprise as excluded leased assets stood out as an anomalous, um, and it's a widely anticipated update. But what it could mean for businesses is that they can have more flexibility in investment decisions at a time when technology is changing rapidly and businesses want to stay ahead of the curve. They can choose to lease instead of buy and manage cash flows, but still benefit from tax breaks. At this stage, the timing and extent of how this will be achieved is still to be seen. There's a wider consultation piece on simplifying the capital allowance regime altogether. So it's a piece to a larger puzzle. The other CT announcement was around R&D and that HMRC are establishing a new expert advisory panel to support with the additional administrative requirements. It does sound like a positive step and hopefully a shift away from HMRC's current approach of opening mass inquiries which have impacted legitimate R&D claims and potentially undermine the objectives of investment in innovation because businesses are being put off claiming relief to which they're entitled. This panel could be useful if it's able to provide clearer guidance as to what constitutes qualifying R&D going forward. There does appear to be more regulation of the tax industry as a whole. So the R&D advisory panel isn't out of kilter with what seems to be a recurring theme. The government did also publish a consultation on ways to strengthen the regulatory framework in the tax advice market, which is another move to clamp down on promoters of tax avoidance while supporting businesses that operate within the spirit of the tax legislation. So it does feel like a step towards a more regulated tax market. So those are the key takeaways from me. Let's kick things off with the wider panel and start with George Lagarius, our chief economist, who will share his economic review and opinion. So over to you, George.
Thank you very much, Pooja. So I will share my expert economic opinion. What I will not share, and you should be thankful, is slides. I decided that's a better day to talk a little bit rather than illustrate everything and, you know, a little bit more death by PowerPoint. So what before we talk about the budget, let's just talk a little bit about the economy and, you know, what sort of economy does this budget deal with. Okay, so this is an economy that's in a technical recession. Technical recession is not as bad as it sounds. It's not really a real recession. We have 2 quarters of negative growth, so technically it is a recession. It's really zero growth for a year. Okay, we expect it to be shallow. Why? Because we see that consumers are resilient. Consumers have been resilient for some time. And I think the reduction in taxes and personal taxes for working people will help even improve medium-term consumption. So all in all, that was the positive effect of the budget, which was it's probably going to have a positive net effect on consumption, and it should help lift the UK out of the technical recession even sooner. To be fair, even if they didn't do that, I would not expect the UK to go into a deeper recession. Now, inflation is on the mend. We expect inflation of 2% or less by the end of the year. That is the market consensus. All other things being equal, i.e., no major escalation of the war in the Middle East or Ukraine, or no major war somewhere else, so something that could cause a supply side disruption. Demand side inflation, although wages are higher, and services inflation is somewhat sticky, still demand side inflation is not that high. We think that central banks are going to be cutting rates at some time after the summer. If things happened as they should, probably the ECB should start, then the Bank of England, and then the Fed. but sometimes central banks just wait for the Fed to kick off. So I'm not sure exactly how this will play out. Now, this is the good news. So whatever Chancellor Hunt said on his speech that less personal tax is good for consumption, that growth will eventually get back on track, and that inflation is, at least this wave of inflation, is nearly over. I think these are statements that are more truthful. Now, what I think is not positive so much is the effect of the budget towards foreign investors. So we need to take a step back and understand that the impact of Brexit has mainly been on foreign direct investments and some confidence in Britain, which used to act as a gateway of American money towards Europe. Now, a key goal of any government is to restore that, but this budget was not necessarily the budget that would do that. This is a pre-election budget, and it was aimed at an internal audience. From political perspective, this makes absolute sense, of course. Having said that, in essence, it's clamping down on buy to rent. It's clamping down on non-doms, which should discourage some foreign investors. And if we're talking about foreign investors who wanted to invest in the FTSE 100 or the FTSE 250, so this British ISA thing could, in theory, encourage some more flows into those companies. And a school would say, okay, if we see some flows into that from internal investors, that some external investors should follow. But I think where the old institutional money, the slow money is concerned, that's not how they would think of things. Um, if I was a foreign investor investing in UK assets and saw this sort of policy, and know that there is an election going forward, then I might question, okay, so what if the next government, if the government changes, takes away that rule? Does this mean we're going to have outflows where we had inflows? And you don't necessarily have to abolish the British ISA. You could just broaden the definition to include European stocks, for example, or American stocks. And so on and so forth, or incorporate it into your normalizes. So a future government could do any of that. So do I want to be more exposed in an index where some of that is subsidized? And that is going to be the question that the institutional and the slow money will have to contend with. So, I'm a market fundamentalist, and generally speaking, I prefer a clean-cut solution. So I understand the need to help British-based stocks because the FTSE 100, only 30% of earnings come from Britain. It's 70% foreign earnings. So, companies like Royal Dutch Shell are not, they are only partly British. So I understand the need to help the stock market there, especially after ARM decided to list somewhere else. But I'm not this policy, direct as it may be, I'm not 100% sure that the net effect going forward, the long-term net effect, is going to be a positive one. So, just to recap, the economy is in a good place. It's in a far better place than I would have expected it to be a year ago. I think we're nearing rate cuts. I think that the cut in personal taxes is a net positive. I think, however, this budget was not something, didn't have something for foreign investors. So I don't know, maybe the next one will, but this one was directed to an internal audience. Um, and with that, I think I arrived at my 10-minute threshold. And feel free to ask any questions through the Q&A. I will be back near the end to answer these.
Thank you, George. Thank you, George. And that sort of links us seamlessly, it brings seamlessly on to Sean to talk about private client matters and what this means for us as individuals. Over to you, Sean.
Thank you, Pooja, and hi, everybody. Yeah, from a private client perspective, there was actually a lot to talk about in the budget. Firstly, there was a fundamental change announced to the current non-domiciled regime. I think to explain this best, it's probably in the first instance necessary to look at some of the definitions. So domicile is a concept under general law, and it broadly equates to the country that a person treats as their permanent home, and this may or may not be the country in which they currently live. This concept of domicile is then imported into UK tax legislation, and it can impact an individual's income, capital, or inheritance tax exposure. And domicile, this is a sticky concept, so it's very difficult to change your domicile. That said, there are some deeming provisions in UK tax legislation which can make non-domiciled individuals deemed to be UK domiciled for tax purposes only. In contrast to this, we have the concept of residence, and residence is where an individual lives in any given year. This can change very easily, and it's possible for an individual to be resident in more than one country at the same time. So applying that to the current set of rules where we currently stand, it is currently possible for non-domiciled individuals who are resident in the UK to limit their exposure to UK taxation for a period of up to 15 years. This can be done by using the remittance basis. From an income tax and a capital gains tax perspective, the effect of this is to restrict their liability to UK taxation, to UK source income or gains, or any funds from overseas that they actually remit to the UK as well. There is a cost to claiming the remittance basis. After a period, you have to pay a remittance basis charge, but for anyone who's got a significant amount of income overseas that they don't intend to bring into the UK, this can actually save them a lot of tax. The regime has been in place for many, many years, and it was originally intended to make the UK an attractive place for wealthy individuals to come and do business, but critics have pointed out that in order to benefit from the remittance basis, it actually means that people keep their wealth out of the UK. So there is a question to how effective this has been. So what has changed and what did we learn? So yesterday we were told that the government is actually abolishing the non-dom regime with effect from the 6th of April 2025. Instead, we'll have a new residency-based set of tax rules in relation to overseas income and gains. And this new regime will be available to new arrivals to the UK who have not been resident in the UK for the previous 10 years. The new rules look like people who elect to be taxed on this new basis will not be required to pay UK tax on their overseas income and gains. These overseas income and gains, though, for the first 4 years of being resident in the UK, and then these overseas income and gains can still be brought into the UK without any tax charge. So it's actually far more generous and a lot less complex than the current rules. That said, in the same way as currently claiming remittance basis, if an individual does elect to be taxed under these new rules, they'll lose their entitlement to their personal allowance. It's also going to be available to individuals who are currently resident in the UK, provided that they've been resident for fewer than 4 years on the 6th of April 2025, again, subject to the same requirement that they were not resident for more than 10 years prior to that. Then after being in the UK for 4 years, people will be taxable on their worldwide income and gains, whether or not they bring it into the UK. So as I say, it's a fundamental change to UK taxation, and as you would expect, there are some transitional rules. These include a rebasing or a step up for capital assets to the April 19 value, where a remittance basis claim has previously been made. There's going to be a 50% temporary exemption for foreign income in the 25-26 tax year only. And there'll also be a new, what's been termed a temporary repatriation facility for the 25-26 and 26-27 tax years, again, for individuals who have previously claimed to be taxed on a remittance basis, but this will enable them to bring into the UK previously unremitted income at a beneficial rate of 12%.
Thanks, Sean. So as I understand it, these rules affect the taxation of income and capital gains. Were there any changes to inheritance tax?
Um, no, not yet is the answer to that. The changes announced do not currently apply to inheritance tax. So inheritance tax will continue to be based on domicile for the time being. That said, in the technical papers, the government did announce that it was consulting on how inheritance tax might also move to a residence-based regime, possibly from, again, the 6th of April 2025.
Okay, thank you. So I appreciate that these rules have only just been announced. Do we have any initial thoughts on what people might need to consider?
Yeah, we've had lots of interesting debate internally and some what I'll call reactionary thoughts. For instance, whether it might be possible for individuals to delay any planned remittances so that they can benefit from the lower rates and the transitional repatriation facility, whether offshore trusts should be put in place at this stage, because we think that they will still qualify as excluded property trusts up until April 2025. And for individuals who have recently moved to the UK, whether they might actually want to again break residency to then come back into benefit under the new regime. But in all cases, I think bespoke advice is going to be needed. And where there are existing structures in place, such as offshore trusts or companies, then I think all of those should probably be reviewed. It's early days, and we're going to be investing a lot of time and effort in the matter in coming weeks and months.
Thanks, Sean. So I was just going to say, was there anything else on the property side for individuals?
Yeah, there was indeed. So there was 3 announcements that related to property taxation. Firstly, the Chancellor announced that the furnished holiday lettings regime would be abolished from April 2025. This is no surprise because before itself it was abolished. The Office of Tax Simplification questioned the effectiveness of the regime. Furnished holiday lets, they have a tax privileged status where a rental property meets certain criteria. Benefits include full relief for mortgage interest, capital allowances on furniture. The profits are eligible for pension contributions, and they would have qualified for various capital gains tax reliefs. But the Chancellor in particular noted that these benefits created a distortion in the rental market, broadly incentivizing landlords to offer short-term holiday lets and reducing the longer-term rental availability in communities. So from April 25, FHL income will be taxed in the same way as other rental income. The second property-related tax measure was in relation to stamp duty land tax and the multiple dwellings relief that applies to property purchases in England and Northern Ireland. This relief can reduce or could reduce the stamp duty charge when buying more than one property, and it was intended to support investment in the private rented sector. But the consultation found no strong evidence that it was doing so. The evidence, in fact, found that half of all claims were from individuals buying property for private use, and there were many instances of spurious claims around whether, for instance, a garage with a toilet in it could qualify as a dwelling. So accordingly, multiple dwellings relief will not be available for transactions that complete after the 1st of June 24, unless the contracts were exchanged prior to yesterday. And finally, on property taxation, the government announced that the higher rate of CGT that applies to residential property will reduce from 28% to 24% with effect from the 6th of April 24. The lower rate will remain at 18% for gains that fall within an individual's basic rate band.
Thanks, Sean. So this seems like further restrictions to tax reliefs available on property income. Is this a case of landlords continuing to be the first port of call when it comes to increasing tax revenue?
Yeah. Well, there was certainly nothing helpful in the budget for landlords. I think over the last decades, landlords have seen their returns diminish through higher costs and the removal of tax reliefs. There's no doubt contributed to increased rents and in turn will have pushed up property prices. So it would have been nice to see some relief given back to landlords, because obviously they're not going to benefit from the NIC reductions that Ian is going to talk to. I guess whilst it will be of little comfort to landlords, the reduction in the CGT rate may be welcome to those who have had enough and are looking to either offload rental properties or exit the market entirely.
Thank you, Sean. That's really, really insightful and a lot to think about. Can I ask Ian Goodwin to join us now to share a employment taxes update? Over to you, Ian.
Thanks, Pooja, and great to hear from Sean as well, and good to be in front of everyone today. The main update from an employment side is one that relates to employees for national insurance. It was very much rumoured beforehand that there was going to be an additional national insurance, and the Chancellor came through on that rumour as well. So an extra 2 percentage points has been dropped off the main rate of employee national insurance. It went down from 12% to 10% in January. It's now going to go down to 8% from April. So people will, I'd say, 4 percentage points in national insurance. What does that mean? That means that employees who earn £50,270 or more will save around another £754 a year. So their net pay will increase by around £754. I'm not going to mention inflation and tax cuts and thresholds remaining frozen, but compared to what they would have had otherwise, they'll be an extra £754 better off. For someone on the new national minimum wage that's coming into being at £11.44, assuming they were paid that already, let's say, they will be £198 thereabouts better off than they would otherwise have been due to the national insurance cut. So in all, I suppose that's welcome news because people are paying less national insurance, and it's welcome news not just for those people in England, but for the whole of the UK. It's not devolved like taxes, so that we won't see the Scottish Parliament making different rules for Scottish taxpayers for national insurance, at least, because they can't. Whether there'll be anything on tax later on, who knows? But that's how that would rule. From an employment perspective, just to finish that off, the employer national insurance, they've not saved. There's no cuts there at all. So the employer has not been given a cut. It's only the employee who's received a cut. So the employer rate remains at 13.8% as it has done for the last 12 months. And that doesn't look like it's going to change anytime soon.
Thanks. That was going to be my question. Anything for employers to watch out for here? Sorry, carry on.
Sorry, just to pick up, there are some things for the employers to watch out for related to the employee national insurance cost. So, for example, where you operate a salary sacrifice arrangement, generally speaking, say pension salary sacrifice or the electric car salary sacrifice that's very popular at the moment, you will have publicised in communications what the employee is likely to save. And that is based on generally national insurance plus some tax potentially if it's the electric vehicle one. Employers should now look to revisit that because those communications may now be out of date. So I would recommend employers look at that as a first port of call. Additionally, you're going to have potentially some people in your organisation that aren't going to benefit from this national insurance cut if you've got people who work for you that are overstate pension age. So where there might be still some pressures on pay and reward in that respect, because not everyone in your organisation may well have benefited from a national insurance cut that other employees have too. And separately, I suppose we're going to have to just watch to see how that interacts with other changes you may have made from a reward perspective too. If you're looking at how you can keep pay differentials for individuals, or if you've actually got the costs available to look at pay generally, what impact will that have when you compare it with the national insurance cut as well?
No, thank you, and that's a really good point. Thank you, Ian. So what about the self-employed? Did they see an NIC cut too?
They did, yes. So it wasn't just the employees that the Chancellor singled out, it was also the self-employed too. It has given them some relief. I mean, we had the abolition of the Class 2 national insurance, the couple of pounds a week that you used to pay, announced in the autumn statement. We also had a small reduction to the Class 4 national insurance in the autumn statement too. He's now added an extra 2 percentage point reduction alongside the 2 percentage point one we saw for normal employees too. So self-employed will also benefit from the same percentage cut in national insurance. So that'll take theirs down, I think, from 8% to 6%, which from my perspective for self-employed people, does it give them something to think about how income is extracted? When you're looking at things like incorporation and other aspects for them as well, I suppose the interaction with dividends if they're looking at that type of thing as well. Is there different cliff edges to think about than there was previously? So I know a lot of my colleagues will be looking at that for their clients who are individuals that are self-employed.
Absolutely, absolutely. And Sean, feel free to chip in if you have any comments on that, or we can pick it up as part of the Q&A. But a big topic post the budget announcement has been the higher income child benefit charge, or HICBIC for short. But what was the update here, and what do employers need to do?
Well, it's one of the talking points after the budget, this definitely. And I think Martin Lewis from Money Saving Expert has been mentioning this for some time, so it was very welcome news from his perspective, and it's been well publicised on his website as well. What the HICBIC was, it was brought in 2013, so over 10 years ago now. It doesn't seem like 10 years, but that has gone quickly. It was brought in for higher rate taxpayers. At the time, the higher rate threshold at 40% kicked in was around £42,500. Obviously, that's now above £50,000. So basic rate taxpayers have been involved and had to do self-assessment tax returns for this HICBIC. Now, by announcing the change from it impacting people with income between over £50,000, so 50 to 60 and 60,000 and above, you've completely lost that. They've now updated it so that individuals will only be affected if they earn over £60,000. So if they earn between 60 and 80, it tapered. If you earn over 80, you won't receive any child benefit at all. So in some ways, that's a welcome change because it will only now impact higher rate taxpayers. But to some degree, it does mean that more employees may have to think about this. Some employees who stopped claiming it because they were just above 60k will now have to think, well, I should claim that again. So there's some decisions for individuals to make, and obviously the repayment of this HICBIC, the higher income child benefit charge, comes through self-assessment. So it's very much up to the individual to look at that and review it themselves. However, it's not to say that employers don't have to think about this, because you'll have people in your workforce who are getting paid between £50,000 and £80,000. This will interact with their net reward, and you'll have to think, do we need to do anything around this? Is there any communications we should present to them to say, you need to think about this, just so that they are well equipped to then look at it independently? The reason why I mention that particularly is because we've seen a lot of tribunals in the courts where the HICBIC has been challenged. People have said, well, I didn't realise I had this, or it's taken the revenue some time to investigate it. And in most cases, the revenue have won that case because they had income that needed to restrict the child benefit that people were providing. So it's very much something to be aware of when you're looking at reward generally for your employees and those that may be at that income levels.
Thank you, and that's really interesting. Can I now ask Linda to join us, please, to share her thoughts on all things indirect taxes? Sorry, Linda, I don't know if you tried to join.
Then there might be one more thing just to mention, Pooja, while
Okay.
we're waiting for Linda to join, that I didn't mention. It
Okay.
wasn't announced in the budget, but the national minimum wage was, obviously, we've had announcements in the past, £11.44 an hour from the 1st of April. Individuals will be, that's another cost for the employer to think about. It'll impact certain individuals as well. But one thing that's connected to the national insurance cut here, and you might think I'm jumping somewhere here, but you may need to start thinking about how salary sacrifice interacts. What I mean by that is you may have had people that can participate in salary sacrifice now because they earn £11.88, let's say, above the £10.42 national minimum wage that we've got at the moment. But come April, if their pay is not going up and they're in pension sacrifice or, say, an electric vehicle sacrifice, they might be benefiting from the national insurance cut, but they might not now be eligible for remaining in that salary sacrifice because it would take them below the minimum wage, which would then impact their net pay. So minimum wage is something to watch out for alongside this NIC cut, and thinking about what people's net reward is going to be. Again, something for employers to think about, to consider what our eligibility thresholds and communication should look like there. So I think I've covered that little point off that I thought was
No, thank you, Ian, and that's really useful to know. And just to sort of summarize on that, if there are employees in your businesses that are at that national minimum wage threshold, it's worth having a net reward review and just making sure that we're all okay from a national minimum wage perspective. So Linda's kindly joined us now. So Linda, can I hand over to you to share your thoughts on the indirect taxes update, please?
Of course, Pooja, thanks very much.
Thank you.
So the change on VAT that has made the kind of biggest impact in the media has been the change to the VAT registration threshold, which has been frozen, I think, since 2017. And it's now gone up to £90,000 with effect from the 1st of April. And that basically allows smaller businesses to stay outside the VAT net if they choose to, which will save them having to charge VAT on their charges and also reduce their admin burden. I think for larger businesses, it won't have any impact. Then there have been some kind of trailed potential changes or not yet changes announced that are a bit more specialist. The terminal markets order, which is an arrangement that allows precious metals and other goods to be zero rated subject to certain conditions, is being reformed and updated. There's been a consultation that happened on that. And they've said that they're now going to bring carbon credits in that regime. And there's going to be legislation in the spring finance bill and publishing the response to the recent consultation. The other thing that people were hoping for, which hasn't yet been mentioned, is the VAT retail export scheme, which was withdrawn a few years back now. That has had an impact on the number of foreign tourists coming to take advantage of tax-free shopping. And what the government have said on that is they're still thinking about it. They're open to further submissions, and meanwhile they're considering the report by the OBR. And then finally, there was a small change announced on DIY house builders, just to allow HMRC to require more evidence, documentation, and that sort of thing. On the duties, there have been a few more changes. There's been a new duty announced on vaping products, and then a one-off tobacco duty increase to kind of keep that differential to make vaping more attractive. There's going to be registrations for the duty starting on the 1st of April 2026 and the duty starting in October 2026. There's also a new falling us in line with the EU, even though after Brexit we've got our own carbon border adjustment mechanism being introduced, which basically makes sure that the cost of carbon in imported goods is reflected. And that's going to be subject to a consultation with the public later in this year. They've frozen alcohol duty until February 25 and fuel duty until March 25, which extends the temporary 5p rate cut that they previously announced. And there are also kind of increases in air passenger duty and landfill tax, broadly reflecting of inflation. And that's it on the indirect tax.
Thank you, Linda. That's a really useful summary. So we've heard from all our panelists today. Can I ask each one of you just to share your sort of key takeaway or something that would be useful for our audience today to take away from the announcements yesterday, and then we can jump straight into the Q&A. Should I start with you, Sean?
Yeah, sure. Obviously, the key announcement from a private client perspective is the non-dom changes. I think it's going to take us a bit of time to work through all the technicalities around those and really come up with plans for those affected. They don't kick in really until April 2025. So in theory, we do have some time to put things in place, but it's one of those things where the playing field is just completely changed. So I very much suspect that the time between now and then will get eaten up very quickly. I can foresee us being busy looking at that for the next year anyway.
Thanks, Sean. How about you, Ian?
I think for me, simple one, make sure your payroll software is updated for the NIC cut, for the new national minimum wage, and anything else it might need. Again, another busy time for payroll. And also the fact that it wasn't announced, but it's kind of in the small print of the budget red book afterwards, I would say. And what we saw with the double cab pickup U-turn that we had a few weeks ago, the revenue are looking to raise tax revenues and are going to be out there doing compliance reviews. So really focus on being robust with your tax governance and making sure you've looked and reviewed things, you're proactive with it, because they will be visiting people very, they're looking to make visits, they're looking to see where they can get tax revenues back up into the exchequer.
Thanks, Ian. How about you, Linda? Did you have a key message for our audience today?
Well, I don't think there's been any wholesale changes on the VAT side, have there? But I think if you're in individual sectors, then there's very much a watching brief on to see how changes affect you. And I think for those sectors, there'll need to be kind of close eyes on the changes as and when they're announced in more detail.
Thanks, Linda. And George, I don't know if you caught that, but do you have any key takeaway for our audience today from yesterday's announcements?
I think it's the same that I gave in my speech. This budget does not, over the long term, doesn't change the fundamentals of the British economy. If anything, it might discourage some foreign direct investment. Over the shorter term, however, it could boost consumption and possibly some investing in British stocks.
Fantastic. Thank you. Thank you, George. So let's jump into the Q&As, and we've had quite a few questions come through. If there are any more, please send them through, but we've had a few from an individual's perspective, Sean. So can I start with you? And can I start with whether these changes have any effect in Scotland and Wales?
Yeah, sure. So, yeah, obviously I'm based in Scotland. So before the election, there was a lot of chat around whether there might be an income tax reduction in the income tax rates, and that in itself wouldn't have affected us up here. So I was actually quite pleased to see the cut in national insurance, because that does apply UK wide. So Scottish taxpayers and indeed Welsh taxpayers will benefit from those changes. Similarly, the non-dom changes are UK wide, as are the changes to the property tax around furnished holiday lets and capital gains tax. I guess the one announcement and all that's not going to be immediately effective UK wide are the changes to SDLT. So the abolition of the multiple dwellings relief. Stamp duty land tax is only applicable in England and Northern Ireland currently. But I think what we've seen in the past is that where there's been a change similar to this, then the Scottish government and Welsh governments have quickly followed suit to make similar amendments to the LBTT and LTT applicable in the respective jurisdictions. So it wouldn't surprise me if actually the Scottish and Welsh governments quickly turn around and say that they're doing away with multiple dwellings relief in the respective tax legislations as well.
Thanks, Sean. And while I've got you here, just a question around the political side of things. So with a potential general election upcoming, are there parts of the budget that are at risk of being changed if there's a change in government? And we've specifically had the question of how that would impact non-DOMs.
Yes, so obviously in the run-up, Labour were making a lot of noise around what they would do to the non-dom regime. And so the question naturally arises as to whether what is now coming in will stick if there was, for instance, a change in government. And I guess, it's the wider question of how permanent is anything in taxation. In theory, the political party that's in power can change whatever they want, but there is, thankfully, a general acceptance for the need for stability and certainty. The changes to the non-dom regime will actually address a lot of the criticism that was levelled against them. And so I suspect that actually Labour will be relatively content with what's been announced. Noting the need for stability, how often can a fundamental concept in taxation change before there's just chaos? So I think in short, I think the abolition of the non-dom regime and the introduction of this replacement will stick. As I mentioned, we're not quite so clear on the future of inheritance tax. So that one has been pushed down the road and is perhaps up to grabs, but that may well follow suit as well.
Thank you, Sean. I have a question here for you, Ian, if that's okay. So the question is, what's the view on the general direction of travel when it comes to national minimum wage? Because the view is that, there've been aggressive targets to meet, and businesses are more and more pressured from the cost side of things, and it's potentially not sustainable. So any insights or personal opinion here?
Very much so. I'd say there's a few areas where HMRC are being, I'd say, particularly aggressive. One is national minimum wage, the other is IR35, last one is vehicle classifications. Looking at national minimum wage, the revenue are doing it in certain ways. So they're focusing on regions. Birmingham has been one, Bradford, Liverpool, Belfast. We thought at one point they were going through the alphabet, but now they're throwing Liverpool into the mix. They're certainly not doing that. They are looking at places where they think there is locations that pay people close or below or at the minimum wage levels, and that's where they're going to actively investigate. We've also seen them look at certain sectors, so childcare, elderly care homes. We've seen it in automotive and manufacturing as well, of starting to look at there. And ultimately, retail's been a big one too. They do look at retailers regularly, particularly as they're household names and good ones to publish on the naming and shaming list. We saw that naming list published earlier in February. 524 names are on that list, and that gets publicly announced. Papers can pick it up. It can damage reputations, and at the end of the day, they're looking to make sure people get paid what they should do. We know the national minimum wage is very technical. Most employers are not underpaying. They're caught out on a technicality. Things like black trousers, working little few minutes extra work here and there, time in lieu that's given off. All those types of things can interact with minimum wage, and it's really important employers look at this. Even the leap year this year interacts with minimum wage, extra day of work. Salaried workers is one to look at there. So it's a very good question, and I'd say probably one of the key focus points, particularly as it's gone up a lot in the last few years. And those salaried workers, particularly who you might not look at their pay as much as, say, hourly paid workers, may now come on the radar, especially where the salary sacrifice arrangements in use too.
Thanks, Ian. That's really insightful and really interesting. George, if I may move on to you, we had a question come through with regards to the UK housing market. You said that the announcements yesterday were sort of internal and UK focused. There's obviously been a CGT cut for the sale of residential properties in the UK from 28% to 24%. What are the government trying to do here? What are your thoughts on this and sort of the wider housing market in the UK?
Okay, so what the government is trying to do is to alleviate some of the pressures in the housing market by prompting people to exit it, buy and rent, investors to exit. I think it's pretty clear what they're trying to do. Having said that, the UK does suffer from a chronic underinvestment in the housing sector, and that will not be addressed in the next year or two. It will take a long time before this is addressed. And quite frankly, as a European national who's lived in a lot of cities, there are cities where their base mentality is just build tall structures to allow for more people to live in them, and there are cities who want to maintain their character. And London falls, at least London, and most of Britain for that matter, falls into the latter category. Okay, less behemoths raised for people to live in. So I don't expect that this will be addressed anytime soon, which is why I don't expect the UK housing market to crash anytime soon.
Okay, no, that's useful. That's really helpful. So thank you. I think we've been through the large part of the questions, and we're sort of at time now today. But if there are any unanswered questions, we will get back to you separately and directly. And thank you for joining us today and listening to us today. And if you'd like more details on anything covered, please do get in touch. Our contact details are here. Otherwise, your usual Mazars contact can look after you. So enjoy the rest of your day, and thank you very much.